Good morning and welcome to this Wednesday, February 10th, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, another day in the books. Market continues to power forward. This is what happens during secular bull markets. Everything just kind of gets tossed to the side. I don't know if you've seen the Volatility Index. We're going to take a look at that in just a bit. But the Volatility Index, if you recall, a little over a week ago with all the Reddit traders, remember, jumped up to 37, which is pretty close to where we normally see intermediate term market bottoms form during secular bull markets. If you get up into the 30s, especially if you were to move up into the 40s, that tends to be where we reach an extreme in terms of fear, and that usually marks bottoms. And that's one of the reasons why we've seen the market bounce back the way we have. That VIX, by the way, which was up at 37, is now back down to 21. It's actually back below where it was before all the Reddit fear hit the market. So, these stories come and go. I know it's sometimes very difficult to shrug off some of the things you're seeing repeatedly and how this is going to impact the market, blah, blah, blah. But you really do need to just kind of focus on the long-term picture of the charts and stick with what they're telling us, not what the media is telling us. Tell you what, before we get into any of that, let me go ahead and go over to earnings beats. Futures, by the way, are up again this morning, roughly about 0.5% across the board, maybe just a little less than that. So it does look like we'll get off to another pretty good start. And earnings continue to pour in. We'll go through some of that a little bit later in the show. But for now, just want to point everyone over to Earnings Beats. If you're not a member, paid member, or if you're not even a community member, a free community member, we've got an Earnings Beats Digest newsletter. Comes out 3 times a week. Just wrote an article this morning. They come out Mondays, Wednesdays, and Fridays. Usually some, pretty good trading opportunities, maybe, depending on your style and strategy. Something to think about. But usually they're educational. I try to make them educational more than anything. But they can pan out as pretty good trading candidates. But if you're interested, type in your name, email address, hit that subscribe button. There's no credit card required. You can unsubscribe at any time. But we do have a lot of folks that subscribe. We appreciate everybody that's part of our community. And we do try to give back a little bit in terms of that free newsletter. This morning was another short squeeze candidate. And I know that's kind of been the buzzword the last week or two because of what happened with Reddit. Wall Street Bets, GameStop, GME, all of that. But this is something we've been talking about for a long time. Short selling is a part of the market, and it's going to be with us. It didn't go away just because everyone stopped focusing on GameStop. It will continue to be something that you need to pay attention to because it affects demand and supply, and that's what ultimately drives prices. So, of course, we need to continue to watch short sellers, short percentage of float on various stocks. If you're thinking about shorting a stock, one of the first things, if I was going to short a stock, probably the absolute first thing I would do is look to see how many other shorts are already on the stock. Because if you're just chasing, if everyone else is already shorting and piling on and you're one of the last folks to jump in, if that stock breaks out, you got unlimited risk to the upside. And that's what a couple of really bad, poorly run hedge funds found out when they were heavily short GameStop. I mean, all you have to do is do a little research and realize that more than 100% of the float is short. Gee, maybe I should have a hedge in place in case this thing starts to break out. Hard to feel sorry for someone who really, to me, that's completely irresponsible investing. I don't know what they were doing. But anyhow, short squeezes remain in play, and we'll continue to talk about it. I posted a blog article. If you didn't see it, I posted a blog article yesterday over at Stock Charts. Well, I'll show you in a second. But before I get to that, I just want to point out we do have our what we call our draft, which is every quarter we draft stocks for our portfolios. I like to call it a draft because I'm a sports junkie. And to me, it's like the NFL draft with one major difference. We have all the draft picks. Nobody else gets to pick Apple, and then we can't pick Apple. We can pick Apple. I don't care who else picks Apple. We can pick Apple. We can pick Tesla. We get the top 10 picks in the draft. How cool is that? All the stocks out there, we can pick the top 10 for our portfolio, whatever 10 we want. We're not limited. It's not that kind of a draft. It's a draft where we own all the stock picks, but anyway, or all the draft picks. But you can check out the portfolio. I mean, it really comes down to a couple things. Number one, my belief that we're in a secular bull market. So I want to concentrate in areas that tend to perform well during secular bull markets. Number two, those areas that perform well during bull markets, I want to make sure I'm getting leaders in those areas. And so essentially what we're trying to do is put together portfolios where we have 10 leading stocks in 10 leading industry groups, different industry groups. I'm not putting 10, auto stocks in there in the same portfolio. Just because autos have been on fire and have been the best performing industry group doesn't mean I'm just going into autos and just picking. Obviously that would create a lot of risk. Same goes with renewable energy. We might have a renewable energy stock in each of the portfolios or maybe in a couple of them, but we're not going to put all renewable energy stocks in a portfolio. That would be, financial disaster if the group just had one bad quarter. So the whole idea is to somewhat diversify, but we're diversifying in strength. We're not diversifying in everything, especially things that have just been horrible performers just for the sake of diversifying. It makes no sense. But anyway, you can check out the results there if you are interested. And we have added recently our ETF portfolio performance at the bottom. The ETF portfolio has been awesome as well. We started it on October 19th, 4 months ago, less than 4 months ago. We're up 24%. The S&P is up 14% over the same period. It's hard to outperform with ETFs, 10 percentage points. We got 7 different ETFs in there. It's not like we've got one ETF. And there was actually an email that I got about our ETF portfolio and said, well, 7 ETFs isn't enough for me. I need a lot more than that. And I just sat back and was thinking about that. Do you know how many stocks are in each ETF? If you've got 7 ETFs and you think you're not diversified enough, I think you need to research what these ETFs do, because many of these ETFs, it really depends on which ETFs you're in. Now, I get it. If you're 7 ETFs, one is solar energy, and then one is semiconductors. But if you get into there are widely diversified ETFs that you can get into. You don't need 50 of those. A lot of times you got a diversified portfolio by owning one. If you buy the SPDR, the SPY, you've got a very widely diversified portfolio with one ETF. So I don't understand the whole idea that you need a whole lot of ETFs. I think you need to know what you own, which is what we, stress. But I don't think you need a whole lot of ETFs. Anyhow, that was performance. Let me go over here to stock charts just for a minute, because I do want to point out in the articles. I wrote an article today, by the way. If you're not a Earnings Beats member, you might want to check this out, because we do talk about all the stocks that are in our portfolios. We're getting ready to draft again in 10 days. But here, this is the list of what we've owned over the past 3 months. And I actually put our history of all of our portfolios quarterly on this table here that you can check out. But you can go down and scroll through and check out the stocks. Here are our model portfolio stocks right there. But go over and check out the article. And by the way, anybody who reads my blog articles, if you haven't already subscribed for it, you can go down here at the bottom underneath about the author. And there's this little box here to subscribe. It's free. You type in your email address, and anytime I publish a blog article, it will be sent to the email address that you provide when you subscribe. So make sure you definitely check that if you haven't already. I used to always publish every day. When I worked at Stock Charts, I would publish every morning, and I would literally try to hit that publish button at 9 a.m., right on the button. So I could try to get that, article out same time every day. Now it's much more, when I have time. Last couple of days, you can actually schedule an article. So last 2 days, 2 nights, I've written articles and then scheduled them for the next morning. So today was 8:30. I think yesterday was 9 a.m. But if you go into my blog articles, yesterday, this is the one where I wrote about another short squeeze play. And this, I mean, when you look at this stock, had a huge move up, sideways consolidation, broke out. Look at the volume coming in on this breakout. It went back down, couldn't quite get to the 20-day moving average, and now has moved back up. And if you click on the chart, it'll give you an update. But you can see yesterday tacked on again. Volume kind of down. I don't see, other than this one day, obviously with the 35 million shares, I don't see a day or any of these days where I see a tremendous amount of short covering. I mean, these are big volume days, don't get me wrong, but I think there's still a lot of shorts out there. And I believe we're going to see this volume potentially accelerate even further, especially if this stock keeps going up. It's going to start to put more and more pressure on those that are holding short positions. So I'm just pointing it out. Again, any of these short squeeze stocks, they tend to be somewhat aggressive. So if you're somebody who can't deal with the volatility, I mean, this stock is at 22 right now, 21.87. It could be 17 in a week. I mean, if you can't deal with that, or you could say, well, I don't want to go down 17. I'll put a stop in at 20. Well, you could be stopped out this morning. I mean, that's how fast these stocks can move. So if you can't stomach that, you have to understand that that's part of what you have to deal with when you're dealing with short squeeze stocks or any highly volatile stock. So, and I just point that out because a lot of folks, I was talking to somebody, a friend of mine the other day, and we were talking a little bit about, people who are getting in the market and they feel like they're not taking much risk when they get into some of the positions that they are, but then they realize that, well, they don't realize it until after the stock's gone down 40, 50, 60%. They didn't realize that they could lose that kind of money in such a short period of time. And I think that's a lot of what's going on with many of the Wall Street bets folks. I mean, if you haven't been in the market for a long time, I remember when I started investing, I made some huge mistakes. I held stocks way too long, and let them just destroy my portfolio. And there are a lot of lessons. There's a lot of tuition you have to pay when you start investing and learning about the stock market and Wall Street and how things work and what the market looks for and what really drives prices and so forth. It's not a game where somebody tells you, oh, the stock's going higher, you want to be in it, and you jump in it without knowing anything, have no financial background, and you're just throwing your money into something. And then you don't understand a week later why you're down 60%. A lot of lessons to be learned. And I can tell you, I bet a bunch of those Wall Street bets folks, some of them made a lot of money, don't get me wrong, but I bet there's a lot of them that were getting in late to the party that are sitting there with major losses right now. So understand your risk, please. All right, moving on to the action from Tuesday. You can see the Dow was flat, S&P was flat, NASDAQ up a little bit, mid caps did a little better, and small caps again led the action to the upside. Small caps doing well. I really like small caps. I like small cap growth because as we come out of this virus and we start to see a little bit of this pent up demand kick in, those small companies that have been able to survive, they struggled more than the big companies during this pandemic. But those companies are roaring back. And part of it is because they can grow their earnings so fast. And so they didn't really participate in a lot of what some of the larger NASDAQ 100 stocks did, Zoom and Peloton, those companies that were rapidly growing their earnings and saw these massive moves. Small caps weren't doing that. Now they're starting to do it. And that's why small caps are so much, I think, a necessity in a portfolio. You want to have some exposure, even if it's to the IWM, which is the ETF that tracks the Russell 2000. I mean, we have our model ETF portfolio, the two we have are IJT and IJR, which is small cap and then small cap growth, two different ETFs. But you should have some exposure, in my opinion, especially if you're a little aggressive or you want a little component of your portfolio to be a little bit more aggressive. I think small caps really what you want to look at. Real estate had a decent day on Tuesday, communication services as well, but energy gave back a little bit. You can see that nice little cup, got up close to where we were back in January, pulled back off of it, not too much of a surprise. I do like energy, the AD line, which is now strengthened with this move to the upside. I'd like to see that continue. If the price keeps going up and all of a sudden AD line rolls over, that would be a little bit of a warning sign for me. Renewable energy, solid day again. We've had a number of days in a row now off that 20-day test or near 20-day test. Now we've got the renewable energy moving higher. Hotels and lodging REIT was on the opposite end, down 3%. And you can see where we were high in December and where we are now. The stock market's been going up, setting new highs. This group has not been able to take out, not even near now, their early December high. They're down more than 10% from that level. This is a group you want to avoid. All right, 10-year Treasury yield. We did have the CPI come out this morning. January CPI rose 0.3%. That was exactly the estimate. But when we strip out food and energy, so if you're not eating and you're not going anywhere, you'll be interested to know that the core CPI was flat. The estimate was for a rise of 0.2%. So when we strip out food and energy, there wasn't any inflation for the month of January, and that was less than expected. And that is what the Fed pays most attention to, is the core CPI and core PPI. So no reason for the Fed to raise rates. I think a lot of what you're seeing in terms of the 10-year Treasury yield in this uptrend, I don't think it's the fear of raising rates. I think it's simply money coming out of treasuries because of what's going on in the stock market. I've said this over and over and over again. One thing that's going to drive prices higher is rotation. We got a lot of new money coming in, but rotation from bonds. You're sitting there holding a 1% 10-year Treasury bond, and you're watching the stock market go up 1% every day. At some point, you're like, maybe I should sell some of these bonds and buy some stocks. And that's what's been taking place, in my opinion. I think we were way overshot to the downside in the yield. I think if there's a bond, or if there's a bubble anywhere, it was in the bond market. I just don't think we're going to go back down and see those lows. I don't know. I don't think we'll ever see them again. I think we're kind of like we were back in the 1960s. And I only know from history. I wasn't studying charts back then. But, the 1960s rates were historically low, had a nice decade of growth. And then we ran into problems, the oil embargo and all that stuff, Watergate, 1970s ugliness in the market. I think, 10 years from now, we probably are going to have problems again. I don't know what they're going to be. I can't predict what's going to happen, but I do believe we've got a decade of growth ahead. And we'll have pullbacks along the way. It's not going to be straight up. It's going to test your inner muscles, your inner self, whatever you want to call it. But yeah, we're going to have problems from time to time, but I think overall the market is going to trend higher for a number of years, just like we've been doing for the last 10. I think we got another 10 in us. That's just typical. 2 decades is kind of normal for a secular bull market run, and that's what we're in. And this is one of the things that's going to fuel it, the money rotating out of treasuries and out of bonds, because there's such a disparity between returns. Anybody who's looking at the stock market and saying it's overpriced based on earnings, you have to consider a couple of things. Number one, the PE ratios, the S&P 500 PE ratios are going to come down as earnings continue to rise and forecasts continue to rise. That's going to change the PE ratio, and it'll change it considerably. So, but even beyond that, the current environment is such that we deserve higher PE multiples because of the rate of growth and the low interest rate environment. We are going to have, I will go on record, we are going to have in 2021 the highest GDP that we've had this century. And it might not even be close. I mean, the Fed has gone out and said maybe 5%. I think it could be even higher than that. I think it could be 6 or more. If you get that kind of growth, the profit growth in these companies is going to be phenomenal. And if you can do it while the Fed is sitting on their hands and not raising interest rates, I'm telling you, money is going to pour into the stock market, and we're seeing it. Anyhow, let's move on. I mentioned the volatility index. Volatility back down. Here was that move up. Market got really scared for a couple of days about Reddit and how a couple of hedge funds were going to take down the whole market. Great Depression 2.0 all over again. Okay, it wasn't quite that bad. I'm a little sarcastic from time to time, but folks were getting really nervous. I know, because I can see my number of emails that come in. Should I be moving to the sidelines? What do you think? This could take down the market. And I don't look at the market. I mean, I am short term in a sense, but my big picture doesn't change because of one news story. Big picture is big picture. I mean, we just went through one of the biggest news stories of our lifetime with the 100-year pandemic, and we're still dealing with it from a healthcare perspective. The market shrugged it off. It took a while. It was pretty scary, but here we are at all-time highs. Same thing with the trade war. I mean, we're going to shrug things off. Yes, we're going to have bad news from time to time. Market's going to go down. It's just the way it works. We don't go up every day. But you got to focus on the big picture. If you're long-term in nature and you're more of a buy and holder, ignore the news. Just follow the charts. Just stick with these long-term charts. If you're a trader and you're trying to time your ins and outs, it's not easy. Be careful, because when you get out, sometimes it's hard to get back in because prices keep going up. So you really want to be careful about reacting to a week's worth of bad news and then saying, oh, this is it, I'm getting out. At that point, probably should be getting in, to be honest. Anyway, I wanted to point that out because the volatility index, since it shot up back in February, March of last year, you can see going back down, we have not had a close on the VIX below 20. So any close on the VIX below 20 is a big deal. Tells us that we're moving to new levels to the downside in fear, which is good. Market's starting to get more complacent. When you look at the S&P 500, it's just starting to have these candlesticks are real small. It used to be huge, then it was kind of huge, and then it would kind of pick up and be a little bit huge, and then it was starting to shrink a little bit, and then it got a little bigger last week with Reddit, and now it's getting smaller and smaller. And as that VIX breaks down below 20, folks that are betting against this market are just going to sit back and they're not going to believe their eyes, because the market's just going to keep going up. It's going to go up a little bit here or there. S&P up 5 points today, up 12 points tomorrow, down 2, up 6, up 14. And that's what's going to happen. And anybody sitting on the sidelines waiting for that big pullback is just going to watch the market go up. That's my opinion. You can believe it, not believe it. That's fine. That's what a market's all about. Buyers and sellers. Believe me, there's plenty that don't believe me. There's a lot of folks that are very bearish, have been very bearish, continue to be bearish. I don't think that's the right side of the market to be on. That's just my opinion. All right, let's talk a little bit about some of the sectors and industry groups before we get into earnings. So I wanted to pull up first technology, because when I look at the chart, first of all, I just see continuing movement to the upside, leadership. And maybe that'll be an even better way to pull this up over last year is just, let me change from candlesticks. But leadership by technology has been awesome. Here was the big move through the beginning of September. Here we are consolidating and have been. I'm telling you, if technology breaks out above that September relative high, I mean, you saw the chart on the absolute. This is the absolute chart. We're already above September high. We've broken out. We're setting new highs, but so has the S&P 500. So this next chart that I showed you was the relative strength. So since September, you can see technology was clearly way outperforming the S&P 500 until September. Since then, we've been sideways consolidating. All right. Now, certain areas within technology, for instance, semiconductors, over the last year have continued going higher. They've done really well. But one of the problem areas has been software within technology, because they topped back in July. And you can see this is part of the big part of the reason why technology has struggled over the past several months. It's been software. Not that software has been horrible. I mean, if I just pull up software by itself, you can see, I mean, we're breaking out. We're moving to new highs. Just relative to the S&P, we've struggled. Now, do you see all these tops coming in here right around 4,400? This one's probably closer to 4,500. I mean, we went 5 months without doing much. From here, mid-January till now, you see this breakout? That is what you got to kind of watch, because do you see software relative to the S&P now? It is on a roll. Now, we don't know if it's going to be like this, which was July. We'll have to wait and see, or August, I mean. We don't know if it's just temporary, but if you see software specifically, and you see technology more generally breaking out above those previous highs, that would be a very, very bullish development for the market. All right, next up, and I'm just going to go over a couple of these areas that I really like. Consumer discretionary. We topped back in October on a relative basis. We've got a nice little relative cup, little handle. If this breaks out, that would really add to the bullishness in the market. You've got, I'm pointing out two areas, technology and consumer discretionary, that are consolidating after huge bullish runs. If they both break out relative to the S&P 500, and I think they're going to, when they do, expect the market to go up considerably higher. Anytime those two aggressive areas of the market are leading to the upside, the S&P generally is going to do very well. And the simple answer for it is, and I'll show you, let's go over to Yahoo. If you go over to Yahoo and just type in, say, the spider, you can come down here to holdings. So you can do this with any ETF over at Yahoo. And when you go down, you see the sector weightings. Well, technology is 24.19%, and consumer discretionary is 12.5% of the S&P 500. So that's 36, almost 37%. More than a third are in those two sectors. So if you see those two sectors breaking out, more than a third of the S&P 500 is basically putting the rest of the S&P 500 on its shoulders and carrying it to the upside. That's what happens during secular bull markets. The problem is folks try to diversify, and you want to be in energy, and you want to be in utilities, you want to be in staples. And unfortunately, those are the bricks that are sitting on the shoulders of technology and consumer discretionary as the entire spider goes higher. So investing in technology and consumer discretionary makes a lot of sense, because those are the areas that tend to lead in secular bull markets. And so again, if you're, wondering, sitting back saying, well, how in the heck, you must be taking huge, huge risks to get your performance, like this. We're not. We're investing. So anytime you invest, you have risks, but we're doing equal weighted in 4 different portfolios. These are 40 different stocks, 40 different stocks with that kind of performance. The model portfolio up 33% this quarter versus 9% on the S&P 500. Aggressive, 40% versus 9%. Strong AD, 37% versus 9%. All three of those, and income even above the S&P this quarter. But all of these are different stocks. It's not like we have 6 of the same stocks in each of the portfolios. They're all completely different. It's focusing on leadership that makes the difference. It's not overweighting into 1 or 2 stocks and taking these massive risks. They're growth stocks. If growth goes out of favor, if you're afraid we're going into a bear market, then yes, these are going to lose probably more than the S&P if you're right, we go into a bear market. I don't believe we're going into a bear market. And I think every quarter that you don't invest in these is just putting you further and further behind the 8 ball. Again, my opinion. All right, let's talk a little bit about earnings. Cisco came out with earnings. And I'm going to start off, market's getting ready to open, but let's just see what Cisco's doing pre-market. They beat 79 cents versus 76 cents. And by the way, of the 24 companies that I looked at this morning, 23 beat earnings. 23 out of 24. Only one home builder missed. But you can see Cisco this morning down $2. Now, it's been running into its earnings. They beat. They're gapping down. I actually think this is an opportunity. You can see the 20-day moving average. Let's look at that price, 46.12. 20-day moving average, 46.15. So we made the breakout above these highs. We just reported great numbers. Accumulation distribution is awesome. And now you're getting a chance to get in to Cisco down near the 20-day moving average. I actually think 20-day down to maybe around 44. I think that would be a great area to consider jumping into Cisco. Now, do I think Cisco is the best stock out there? No, I don't. I think there are a lot of companies that look better. But Cisco's just making a nice breakout out of this base for an extended period. They beat earnings and they're gapping down, giving you an opportunity near the 20-day. I think that's an interesting play, potentially. The one company that missed earnings was a home builder, Taylor Morrison. They came in at 72 cents versus 82 cents. And, the market just opened. That's why it's not showing me anything here. So let's see if I, oops, I'll do it up here. The stock's down 2.6%. I would have expected a bigger drop, to be honest, after missing, because not too many companies are missing. Let's see what else. Enphase, which is one of our portfolio stocks, ENPH, reported. You can see the stock gapping up $15 today, up 8%. Their numbers came in at 51 cents. They were expecting 40 cents. Lyft came in at 58-cent loss. The market was expecting a 71-cent loss. And Lyft is seeing a lift. Stock up more than 9% so far today. One stock I thought looked really good on the earnings. I'm going to see if they finally made this breakout. Alteryx, AYX, it's a software company, 62 cents versus 29 cents. And they are gapping down. I don't know what is going on with this stock. Gap down, gap up, huge gap down, big gap down. The earnings look good. Maybe they missed on revenues. I didn't see their revenues, or maybe they lowered guidance. But whatever the case is, the stock has gapped down 11.6%. I thought maybe this has been a stock, if you go back and look a ways, I mean, this has been volatile, but it can really move. I mean, look at that. A lot of sideways action for the past year and a half. So I was thinking, okay, maybe this is the time that gets that breakout to the upside, but nope, not yet. Let's see what else we have. Twitter reported. Twitter came in 38 cents versus 30 cents, gapping up 11%. Looks awesome. Akamai beat by a penny, $1.33 versus $1.32. And that's not enough. Stock down 9%. And by the way, I mean, you're seeing gaps in both directions here. This is what I always say. Holding into an earnings report is, I mean, all these companies beat earnings estimates, every one of them, but you can see the different reactions. Beating estimates doesn't mean you're going to gap higher, especially if they lower guidance. Or sometimes these companies have big runs into earnings and then they don't raise guidance and it disappoints investors. So you have great numbers, but sometimes they just don't like the fact that, guidance wasn't raised. There's all kinds of different things. Another software company, Rapid7 RPD, they came in at a 7-cent loss versus 8-cent loss. Yelp was expecting a 1-cent loss, and they came in with a 27-cent gain. And Yelp is trading, about flat. Okay, so we got one earnings report that's flat. This morning, a couple bigger reports that came out. Coca-Cola, KO, 47 cents versus 41 cents. Still struggling. I mean, just recently we were near like 5-6 month lows. Look at the AD line. Only thing I can say is when I see a stock like this, I just want no part of it. And Coke's a great company. Don't get me wrong. Great company. Long term, it'll be fine. Short term, I think you got to be a little careful here. One more earnings related stock, GM. GM came out pretty good results. $1.93 versus $1.62. And seeing a little selling on the news. GM's had a pretty nice move here, General Motors. Good volume, a lot of accumulation. Honestly, I think it's all about Tesla and NIO. And I think those two are carrying a lot of the other stocks in the portfolio or in that industry group higher. We're seeing it with General Motors. We've been seeing it a little bit with Ford. There's Ford, you can see also doing really well. But AD lines, I mean, they're just nothing compared to like Tesla, which has been very strong. I think NIO's has been very strong as well. Yeah, NIO's up there as well. So those to me are the two elite stocks in the auto area. All right, last thing, 3 you must see. I'll give you 3 more earnings reports. How about that? Let's start off with looking at some that beat pretty handily on earnings. Let's start with CCK, which is Crown Holdings, $1.50 versus $1.28. And what you want to see here is a close above 101.37. Today's high was 101.41. So we were right up there. This could be a test. This could be a little cup. And then we form a little handle coming back. The fact we didn't open above resistance tells me that the odds, in my opinion, are probably greater that we don't make the breakout, but we could. I mean, it's nice. I think it's a pretty nice looking stock, actually. There's a lot worse out there for sure, but I would suspect that they're going to fail on this particular attempt. Maybe go back and fill the gap, maybe get back to the 20-day. That's the way I would look at the stock right now based on the way it's trading. Another big winner overnight with earnings was EEFT. They posted earnings of $1.11 versus 72 cents. So EEFT, and the stock's up 46 cents, 1/3 of 1%. Looking at it, you can kind of see this high right here. And when we went up, we came back down, essentially held that level. I think 120 is a pretty big support area. 150 is your resistance. It's in that trading range. It's in a nice group, financial administration, but it's just not been a great performer on a relative basis. So I'd probably look for more consolidation here. And one more. Let's look at IPG. So IPG, Interpublic Group of Companies, they reported numbers 86 cents versus 82. Yesterday on my Trading Places show, I talked a little bit about media agencies and how this has been one of the hottest areas of the market relative to the S&P 500. You can see that at the bottom panel of this chart. But look at IPG relative to its peers. It's just not a great performer. So this move to the upside, to me, it's just a rising tide lifts all boats. It's in a great area. It's being lifted because there's a lot of money going into this area, not necessarily because of this company's specific performance. So they did come out with decent numbers, but you can see it's more of a sell on the news, relative strength near 52-week low. I'd look elsewhere in this group. This is not the stock that I would be looking at in this group. All right, that's it. Let's get a quick update on the market, and then we'll wrap this thing up. And currently, we've got the Dow up 111 points, S&P up 15, new record, NASDAQ 64, new record. So market looking pretty strong here, continues to push higher. Small caps kind of going along for the ride so far. We'll see whether or not they break out into leadership again later this morning. But overall, pretty good action again as we start this Wednesday. Everybody have a great day. I'll be back tomorrow over at stockcharts.com for your next Trading Places Live. That'll be on Thursday morning at 9 a.m. Have a great day, everybody. Happy trading.